Right, I think we are on. Can everybody hear me?
Yes, perfectly.
Thank you very much. Good morning to everybody, and many thanks to Ibrahim and FinTech Robos for having me, for having all of us join in this important discussion, which I think is gathering steam, attracting more and more attention in the region. Long overdue, many might add. Unfortunately, we have lost one of our speakers, Andrew Riley from the OECD, who has a medical emergency within the family. So our best wishes go to him, and we will try to reallocate the questions, the issues among ourselves. I'm joined today by a very knowledgeable, distinguished panel of experts. So hopefully we'll have a rich and informative and interesting discussion about an issue that is really, if not the only, certainly one of the white elephants in the room in the regional evolving policy debates. My panelists today are Jean-Xavier Bourg, who is the head of OCIO Investment and Strategy Advisory at Amundi Asset Management. Shireen Hussain, who is Professor of Health and Social Care Policy and MENA Research on the Aging Healthy, the Menara network based in London. Amar Al-Abaidli, based here in Bahrain, Director of Research at Dirasat, the Bahrain Center for Strategic International and Energy Studies, and Hazem Abdurrahman, who is an actuarial consultant at Mercer. Our panel today specifically is dedicated to the issue of what is known in the sector as longevity risk. Specifically, what do the regional demographic dynamics and associated risks tell us about the MENA pension landscape over the next 5 decades? I think this is, as I said earlier, a very, very important topic, which still is not attracting the attention that it really and truly deserves. In the Gulf region, policy discussions have started around tweaking, reforming the regional pension systems. That has been a fairly gradual process up to now. Yet the reality remains that even though the Gulf and broader Arab pension systems and social insurance systems are not old in international comparison, they were established at a time when the economic and demographic realities in the region were very, very different from what they are today. And that, of course, attests to the rapid pace of development in the Gulf over the past half a century or so. To give you a flavor of what we are up against is, for instance, the so-called old age dependency ratios in the GCC countries, were under 5% in 2015. These are obviously countries which many people still think of as young societies. But the reality is the 65-plus-year-olds have for some time been the fastest growing population stratum. And this old age dependency ratio, for instance, is projected to increase to over 20%. So quadruple in relative terms over the next 30 years, which of course is a dramatic change and a major challenge to the regional pension systems as they are currently designed and operated. So without further ado, perhaps I can start out with you, Shireen. Start with a very basic question that goes to the heart of this debate. What exactly is it that we're talking about when we talk about longevity risk, and why in general is it such an important issue in pension discussions and debates?
Well, thank you very much, Jarmo, and good morning, everyone. It's a pleasure to be here. So basically, longevity risks is the difference between when, kind of pricing assumption, when you start to contribute to a pension, and there are assumptions around life expectancy and for how long pensions will be paid. And then these life expectancies change. So that's a difference between the actual survival rate and the assumptions used to base the calculations when initiating the pricing assumptions. And of course, the risk exists because we have to think about when people start their contribution or the labor market, entering to the labor market. And obviously, life expectancy has changed dramatically, particularly in the region over the past 20 years. And as Jarmo says, it's going to change even further. And the whole structure of the population is changing. So we need to think about kind of population aging, not only as a single dimension that people are living longer, it's the whole structure is changing. So more people are, the proportion of older people are getting higher as we talked about the old age dependency ratio. And hence there is also an impact on the working group, part of the equation. Hence, it's very important to think about these longevity risks. And the problem with longevity risks that are still unattainable and still unmeasurable, because you can't predict to a certain limit into the future based on mortality trends and survival rates and previous life expectancy. We cannot see and foresee what's going to happen, for example, in medicine, in improving the quality of life, on how long people will live. In addition, we see like a lot of outliers, so people who live for quite a longer period of time, and this has this kind of significant implication on the period of time that these pensions will be paid out. And of course it has effects on other parts of the sectors like the health and long-term care. And as we've heard this morning, when Treasury kind of, particularly when we talk about pensions within government, obviously there are private pensions, you have to think about different systems and how you fund different systems. So when we think about the Arab region, one of the key issues as well is a huge volume of people retiring. So we need to think about the historical high fertility rate. So we're not only getting people living longer, but we're suddenly having a considerable large volume of cohorts living longer. So that's in particular to the Arab and MENA region. And also when government promise or a business promise a contribution, they have to provide it. And there are different ways to tackle this, but it's very complex. But one perhaps optimistic point is to think about what we call the population dividend. So at the time being, the MENA region compared to Europe, for example, they have a window of opportunity because we have the youth bulk. But we shouldn't be fooled with this if there is a differential between population demographics and system demographics. So we know that not every young people are in employment, not everyone contributing to taxation and to pension contribution. So that's an area where we can think about as well. So it's really a balance of bringing in a lot of people into the labor force participation in a documented way, paying taxes, contribution, but also there are huge risks associated with previous historical pension regimes, and many of our countries are actually reforming their pension schemes, as we heard in the morning session from Egypt and from Bahrain.
Thank you very much. Now, you've sort of touched on the Arab world a couple of times in your initial remarks. Where do the Arab countries and I suppose the GCC countries in particular sit in global comparison when it comes to longevity risks, both the issue itself and perhaps the extent to which this is understood and appreciated in the policy debates? How important an issue is this in concrete numbers in the Arab world?
Yes. One of the interesting things that we still view, or especially internally, we still view Arab societies as young populations, and that is because of the historical trends. Comparatively, at the time being, we're still kind of young ages. However, comparatively, again, we have a very, very small window, what we call the aging transition. So the aging transition is the period of time when you have a relatively small proportion of the population aged 65 or more, which is we have an arbitrary point of 7%. And once this point reaches, if this percentage is 14%, then you actually completed your aging transition. So I want to give you just a few examples. So thinking about France and the UK, when this process happened in the, starting in the 1900s, they took around 100 to 150 years to complete this transition. Think about the GCC countries. They were going to start very soon. So they are just about to start. So mid-30s they'll start, and it will take an average 12 years to complete this transition. This is a kind of a scary number because it's very small in terms of policy reform. So this is considerably kind of a pressing issue and a pressing policy issue. It's 12 years. It's a very small window to think about reforms, to think about how you are going to address the needs of older people and older workers. So it's not only in a needs base, but also you have expertise. You have people who are coming into retirement age and thinking around. It was good to hear that Egypt's thinking about increasing retirement age, but thinking also about increasing the capacity within the population who are actually, could work in the employment working age. And I think this is the point between demographic dividends and system demographics. So population demographics and system demographics, which are very important. So while we're thinking about, yes, we have the window of opportunities of the youth bulk. However, not everyone is in employment. So the pension system demographics is quite weak. We don't have this many people working and contributing, or we're not operating on full capacity. So just to give you an idea where we stand with the speed. So we have, for example, in the region, Lebanon, Tunisia, Algeria already started their aging transition, and they only have until mid-30s. So they are already kind of coming to the final stage of aging transition to become actually aged populations rather than aging population. So from my point of view, it's a considerably significant change, but it's also happening in a bit of silence. It's not gathering perhaps the enough policy attention, and that is understandable in relation to other pressing issues. So youth unemployment, poverty, healthcare needs, but it's something that if we didn't pay attention to and prepare to, there won't be enough time to meet. We don't have the luxury of what's happened in Europe, and that's because of the whole changes in fertility rates, changes in mortality rates that's happening so fast.
Thank you very much. Now, Amar, if I can come to you, focusing more on specifically the GCC region. And here, of course, until recently, and really in some ways even today, people sort of hold up and understandably increased longevity, improving public health, the demographic profile as positives, as achievements, and yet this anxiety, if you like, around the pension issues, aging, etc., has clearly started to mount and has started to translate into certain policy steps as well. Now, if we go back to Shireen's comments, the reality today is we have a freight train heading towards us, a very sudden and significant change in the regional demographics, with a system that as of today is very poorly prepared to deal with that change. What is your assessment? How well is this understood? What is the readiness to deal with this issue, to rise to the occasion in a timely manner?
Well, first of all, thank you to the hosts for inviting me to participate today, and thank you to you, Jarmo, and my fellow panelists. There's a couple of things you have to note to keep in mind when looking at pensions in the Gulf that differ to the rest of the world. The first is that migrant workers represent a very large percentage of the population and of the working population in countries like Bahrain, especially in countries like the UAE and Qatar. And as a consequence, these migrant workers, first of all, are generally speaking not owed any pensions from the country they're working in. And they come for a short sojourn, maybe 2 to 10 years, and then will go back to their own country or to another country. So for that's one factor which pushes people towards not thinking actively about the pensions issue at the national or the strategic level, because it's a non-issue from the society's perspective for a large percentage of the workforce. The second factor which also pushes people, I should say, towards sort of ignoring it, is that the way in which the government has been structuring society and economic relations after the discovery and development of oil resources in the 50s, 60s, and 70s, this so-called rentier state model, is such that people expect salaries in perpetuity from the government, either in exchange for their work in the public sector or thereafter as part of a pension they're being promised. And this accounts for a large percentage of the employed citizenry. And so again, whereas in a country such as the UK, as much as 80% or more of the population work in the private sector, and for them, thinking about their pension is something which probably comes to mind quite early in their working lives. In countries such as the UAE and such as Kuwait, this is something which is just not salient in someone's thinking, even if that lack of salience is probably an imprudent thing from the perspective of the individual. Now, add to that something that working in parallel, which is that the Gulf countries in general have a poor track record about making use of what I would call their elder statesmen. I mean, you mentioned that longevity is something which is viewed positively. We're making people we're able to make people live longer and to be in good health for a longer time, and that's certainly a good thing. But obviously, it creates pressure on the pension system. But at least in the in OECD countries, it's still the case that even people who have gone past retirement age are considered able to make positive contributions to society through their work, through their skills. If you see, for example, elite, if you go to a university, if you have a full professor who's retired, he will still be a professor emeritus at that university. If you go to I work at a think tank. If you look at many Western think tanks, their chair people are retired diplomats, retired ministers, former members of the former elite decision makers. So there's a sense in OECD countries that even though somebody has reached retirement age, they can still continue to be productive and contribute. Unfortunately, in the Gulf countries, that's not something which happens. When people retire, they tend to, professionally speaking, disappear and not continue to contribute to the economy in an active way. Now, having said that, this is something that's changing slowly because the public sector and the private sector are now starting to become starting to rationalize due to the economic pressure they've been facing with falling oil prices. And in all sectors, we've seen a shift towards more meritocratic hiring practices and therefore a greater appreciation for the older generation's experiences and skills insofar as they exist. And in addition to that, there's been a much higher investment in education in several of the Gulf countries, which helps to increase the sort of perceived economic value of the older generation and allows them to continue contributing to professional life. But for the most part, there is, and we'll come back to this perhaps later on in the talk today, there's still a fundamental lack of awareness about this issue because, compared to OECD countries, because of the fundamental differences in the structure of the economy and the labor market.
Thank you very much. Hazem, if I may come to you, your company, of course, is one that looks at pension systems and works on reforming pension systems on a global scale. And as a reflection of that, you produced the Mercer CFA Pension Index Report, of which the 2021 edition has just come out. Maybe that would give us a good intro into your perspectives on the pension providers' economic systems in the Arab world. How do they stack up vis-a-vis the rest of the world, and how do you view their readiness to deal with these upcoming challenges?
Yeah, thank you. And I just want to thank FinTech Robots for this amazing conference. This is a great opportunity to bring everyone on the table to discuss very important topics. So before I tap into how well positioned the plan sponsors in the Arab worlds are, just would like to point out that the demographic trend that's mainly caused by that increase in life expectancy or the declining fertility rates is going to lead to a larger cohort of the population being in that age of 60 plus. And that would also increase, or we're going to have an increase in the old dependency ratio. So if we look at the dependency ratio, and we can put some numbers to it, if we look at the GCC 20 years ago, and taking, for example, Oman, there was around 15 employed individuals for every person who's age 60 plus. In the UAE, there was around 40 individuals or employed individuals for every person who's age 60 plus. And that figure is expected to drop to around 3 people or 3 employed individuals for every person who's age 60 by the year 2050. That's like a huge increase, or that an increase in, or we're going to have less people in the working sector to support those people of an older age. And that would have an impact or an effect, especially on the sustainability of the pension systems. And it can also add a burden on the governments. So I know that there are some reforms that are being taken place in the region, but yet they are not keeping up with that trend. And we also need to keep in mind that people in the Arab countries, they typically rely on their extended family for that support and safety at an older age. But what we see also today is that that family support is less than what it used to be like for different factors, such as the new family roles or the structures. And that is adding some kind of a pressure on the financial security of those individuals in the older population. And if we look at the GCC, for example, we have there are a lot of social programs other than the pension programs. And these programs are the programs that support the citizens in old age. Now, if we want to look at a bit of the projection or how that trend of that older population is expected to look like, it's expected to increase from around 3% as of now to over 20% by the year 2050. And that trend, as mentioned, it's not just in the region. It's also it's a global trend, and that it's known that those individuals of older age are expected to double by the year 2050. So with that, like promoting some kind of a private pensions or alternative saving solution can definitely put the Arab world in an area that would be better positioned to deal with that demographic trend.
And how ready would you say these countries are for such a proposal? I mean, makes sense, of course, very much in line with for instance, the World Bank paradigm, the model. But some things are easier said than done. It hasn't happened up to now.
That's true, and I totally agree. I believe the focus on the private pensions or adding a pillar. If we look at the World Bank retirement income system framework, which is focused on five pillars. Currently in the region or in the Arab world, those five pillars are not in place. We lack a lot of support or a push when it comes to the private pensions or the voluntary funded pensions. Those two pillars, they can definitely support with that risk and will help people in the future. So I think the focus should be around the private pensions and the voluntary saving solutions.
Great. So now we are beginning to transition, it seems, from the problem, hopefully towards the solution. If I may come to you, Jean-Xavier, we've enumerated a long list of structural challenges for the Gulf region, for the Arab world, and of course these are not unique to this part of the world. They are reflective very much of global trends. In practice, what kind of tools do pension providers, all kinds of pension providers, have to mitigate the impact of these future demographic trends, or to better prepare for them and manage for them? And what is your take on how much realistically can be achieved through such mitigants? So very often, of course, even though in theory a solution exists, its effectiveness, its ease of implementability may not necessarily be sufficient to fully solve the problem.
Sure. Thank you very much. Good morning, everyone. So indeed, the backdrop that's been very clearly set up by my estimated colleagues. The good thing, I would say, when it comes to GCC and the MENA market in general, is that as explained, these countries, your countries, are really in the middle of a significant demographic switch with the significantly decreasing dependency ratio. But the important thing to have in mind is that, as Shireen explained earlier, the developed market has been through that transition, although on a way smoother path, but over the past few years already. So we already have a kind of an idea of how you're able to anticipate these switches and what can be done to trying to mitigate the problems that you can face when you have I would say, assumptions or projections that have been probably a bit over optimistic. So this pressure on the pension fund can be mitigated in several ways. So obviously we have many different type of pension systems, and the 5-pillar framework that you just described actually encompass several of them. When you have a pay-as-you-go system where actually there is this full intergenerational solidarity. Obviously, the question is more on the fiscal side. So I will focus my speech today mainly on pension funds, on defined benefit pension funds, which are really the ones that are at risk with this longevity risk and this aging population, especially if you make wrong assumptions around this. So the main mitigation factors can be actually worked around the main pillars that are actually guiding the financial stability of these pension funds. The first one is around liabilities, and this has been already mentioned earlier. The ultimate goal is to really have a clear understanding on the trajectory in which your liabilities will evolve over time. So really have in mind that having precise dynamic life table and to be able to encompass specific regional demographic analysis is a paramount. So really have a deep knowledge of your population, of your retiree population, given the specific GCC situation that was just mentioned by Dr. Omar, the fact that you have a lot of expatriates, for example, and so on. So that's really the specificities of the regional factors is very important to capture in order to make sure that the trajectory, it is obviously a very long-term exercise. It's an exercise that has to be done over more than 50 to 70 years, even to 100 years if you take some of the tables. So it's really a difficult exercise, but that needs to be done locally. The second layer, once you ensure that you have a good understanding of your liabilities, is to build a sound ALM framework and to try to hedge what can be, and if you want to be. So basically, if we think about the longevity risk, there are many tools that are available that some of my colleagues here are more expert than I am, so we'll probably discuss about them. But hedging tools, either for regulatory purpose or simply with the idea to transfer some of that risk to specific third party like insurers. This is a very common exercise that is done. If you think about the UK or the US, really, the pension fund industry is very well used to transfer longevity risk to the private sector through buyout schemes. So that's a tool that can be used really to ensure that your ALM structure is actually hedging some of this uncertainty around longevity and these demographic risks. Now, if you go on the asset side from the pension fund, assuming that your pension fund is setting aside some assets over your working life, and that you actually use the proceeds of the investment of these assets while you retire, aging population, just on the pure asset side, is a challenge in itself. Obviously, I would say the academic knowledge is usually to say that an aging population is pointing to a lower growth potential. So obviously, when you think that a significant share of the pensions are actually coming from the income generated by the investments over during the working life, that will be a challenge, because you cannot assume that you will be able to make as profitable investments as we have been used to in the past. And this lower growth potential is indeed pushing to lower rates. That's I would say the first degree analysis. But it's a bit more complicating, because we know that if the population is aging and these pension funds are actually depleted by payment of the different pensions, then savings will decrease mechanically over time, and hence the impact on the asset side, because having fewer savings and potentially at some point savings getting below investments, then that would push higher rates. And at the same time, we know that young and elderly population are more inflationary, than working population. So the pension fund system might be in a situation there where that could be very challenging for them, of having low growth, low return, and high inflation situation. That would be, I would say, a difficult situation for the financial stability of the pension funds. So really, an idea is really to take into account all these factors to make sure that you calibrate the replacement rate, for example, accordingly. When it comes to the specificities of longevity risk, I would say the whole industry is trying to look for new ideas and good ideas. So we have, for example, we have seen Tontine coming back, and specific historical options that were used in the past that are actually back on the table. But I would say if you focus on the most on the countries where the baby boomers is really impacting the most currently in the developed world. So if you think about the UK, the Netherlands, the US, Europe in general, the preferred road for now is a smooth shift from a pure DB to I would say an intermediary state between defined benefit and defined contribution, where all the longevity and the financial risk is transferred to the pensioners by these so-called CDC schemes. Basically, the idea is to share some of the risk and the longevity risk to actually keep these risks not at the individual level, but to have this intergenerational solidarity that would allow to have somehow a smooth transition from a DB scheme that really can be financially endangered by the projection that we have just discussed, and a pure DC scheme that really send a lot of burden of the risk sharing, of the risk bearing on the individual pensioners. So really, it's an intermediary solutions that is currently being tested in these countries, and I would think it's a very situation to monitor.
Great, thank you very much, Jean-Xavier. Now we've heard a lot on what the Gulf countries or the Arab world could do potentially to fix their pension challenges, what the possible tools might look like. Now, knowing what you need to do is one thing, doing it is another thing. And when we look at the way the discussions in the region have been evolving, of course, many people are thinking in terms of, okay, there's this money in the kitty, the demographic structure is changing. The solution is to increase the retirement age, and many countries this has started to happen, obviously regionally and globally. Now, as you know, we had this polling question for the audience about this very issue. Do you believe that retirement age should be increased in your country? And interestingly, 2/3 said yes, it should be increased, and obviously the rest didn't quite buy the idea. Shireen, when you look at what's going on in the Arab world today, how do you see the system of pension provision in the region changing in response to these realities? I mean, how much of a solution is this increased retirement age? How ready are countries, governments to go for something more fundamental, if you like, a paradigmatic rather than just a parametric reform solution?
Yeah. Well, thank you very much for the question. I think we need to think about aging and pensions, particularly pensions, as part of broader systems. So there are the social protection. People, eloquently talked about intergenerational solidarity, and we know in the region actually the flow of wealth is usually from older people to younger people. So we need to bear that in mind. So thinking about different mechanisms that support the whole society. So there are mechanisms to support the whole family, to support people, but also we need to shift our societal thinking. So the point that Omar has made about, working beyond retirement, it's a good thing. If we retire at 60 and the average life expectancy is 85, that's 25 years of your life if you're not doing anything. That's not, it will be better quality of life if you're productive. And I think this is a societal perception shift, and I think this is really important to talk about these things. So it's part of a framework that is, for example, the WHO puts a healthy aging framework where the functional and intrinsic capacity and the later life learning. So basically, the three parts of thinking about responding to population aging and pension are three elements. So increase employability. So the employment, and this is not only the employment of younger people, which is something that our board needs to do, because I think Omar put it eloquently, when you have migrant workers, then you kind of think we've got enough workers, we don't need to work, or not everybody needs to work. I think everybody, has to feel that the need for work and work in a regulated way and pay taxation and contribution. And also older people, older workers. There are a lot of, Jane have talked about, in Europe, the kind of re-entry into the job market, and by choice rather than by enforcement. And the second one is higher contributions. So obviously, the kind of you contribute more, you don't expect that you have to contribute, and there is a lot of technical issues behind that, and the kind of specific data, dynamic life tables, understanding what is the contribution has to look like to be able to kind of mitigate the longevity risk and reinsurance, etc. But from a societal point of view, the contribution has to be accepted that this is part of life. We don't expect the government to pay for everything. You have to contribute throughout your working life. And then there will be financial deficits. And I think this is where taxation comes in, and where actually the GCC countries might be in a good position because of the migrant populations who are not expected to retire, or maybe not entitled to retire in these countries. So they're basically contributing taxation throughout their working life that will go into the pension scheme for the citizenship group. So there are three elements. I think one of the most important is this societal shift in thinking about aging and the perception of aging. And it's a good thing to continue working, and it's a good thing to be attracted to work at the first stage. So I would take it not only from a kind of an economic and financial aspect. These are crucially important, but also it's a societal and issue and perception issue, and we need to think about it from that way, changing awareness, kind of improving the ability of people to so the later life learning, digital technology, retraining and re-employment. Japan is a good example, because Japan is is the most aged population, and they have the most number of older people working in the economy. They don't rely on migrants, and this is where we can go. And the other point I want to make is distributing risk. So pension is not the only income. So maybe introduce something like long-term care insurance. So that would cover the health and long-term care needs when people age. So you kind of distribute where your income coming at old age.
Thank you for that. Now, a cynic might say to you, and forgive me for sounding like a cynic, nice work if you can get it. As Omar pointed out, a lot of these grey wolves, so to speak, are kicked off into peaceful retirement, partly because societies still, in terms of their perceptions, are not ready to, I think, wrap their minds around this demographic transition. And a lot of the policy discussion today, and of course this is partly because of COVID-19, but not only, is around unemployment. We have all these young people, they need jobs. And the idea is we fix this problem through distribution. So we send people off into retirement, young people have more jobs to take on. How do you deal with this?
I think it's a very good point, Jabo, and this is why societal perception change is difficult. But you have to work with younger cohorts, and I think the more we talk about these issues, the more we talk with policymakers, the more we make them think about this potential. And we do have a window of opportunity, as I mentioned earlier, with the population dividends. But this is not going to last for long. And I think if you bring it in from a positive return for the retiree to work and to engage. And there are flexible ways of working. So don't expect people to work full time if they don't want to. And also to differentiate, we didn't talk about inequalities and differentiate about the type of the work that people do. So we have people in the region who work until they drop dead because basically they don't have any protection, they don't have any other income. And you want to get a balance that actually work at later life is a good thing if you choose it, if there is opportunity. But even if you choose it and there are no opportunities, because of exactly what you said about the competition, that you say, oh, if an older person stays at work, I've lost that opportunity. That's not true if you expand your labor market, if you diversify your labor market, and you attract people with different skills. And relearning, so later life learning is really important. So yes, it is a difficult task. But we started this process by just talking about it and talking to policymakers and thinking about it positively as well. So it's not a punishment to ask you to retire late. It's a good thing. And as Omar said, emeritus professor and kind of elite, they talked about elite, but it's not only elite. People like to work because work is rewarding. But obviously you have to choose the work you're doing, so not forced to do it. So I hope we're starting the conversation and the journey.
We are starting the conversation, it sounds like. Thank you very much. Now, we've started to get some questions from the audience, and I would obviously encourage more. I think some of these we've already addressed. Some of the others I will try to weave into the questions to our presenters, and then hopefully we'll have some time for freer Q&A. Hazem, if I may come back to you now. Obviously, Jean-Xavier talked about the defined benefit schemes, the challenges those face. When we look at the GCC government pension funds today, these are defined benefit schemes. So, if you like, the biggest problem you can have in the business. How much do you think they are doing? How much do you think they can do? Are there sort of best practice examples within the region? And linked to that, and this is one of the audience questions, is that when we look at countries, for instance, in Europe that have sort of expanded, diversified their systems of pension provision by adding the second, third pillars. One of the sort of catalysts has been the use of tax incentives, and of course, that is not an easy thing to do in the Gulf, given the fact that there isn't a personal income tax system as of today. So, what is your answer to these questions?
Yeah, sure. First, I'm gonna echo some of the points that already been mentioned. So please bear with me, everyone. So now, again, in traditional defined benefit plans, usually the plan sponsor, or in this case, the governments, they take on that longevity risk by guaranteeing that lifetime annuity to their retirees, right? And that impact of the longevity can be mitigated using different measures. Of course, they can differ from the private sector and the government sector. So on one hand, you can introduce some kind of parametric reform, such as increasing the normal retirement age, plan redesign, or you can play with the duration of the plan assets by using different capital market derivatives, such as longevity swaps. In addition to that, plan sponsors themselves, they can provide that additional funding to the retiree group if they are expected to live longer than expected. So on the other hand, that whole longevity risk can, as mentioned, can be transferred into a third party by purchasing annuities for the retirees or for those under long-term disability. In addition to that, there are like other longevity risk hedging products, but they are more evident in the private sector and not in the government sector. And it's been spoken about like annuity buyouts or transferring that risk itself. It's more evident in pension plans, but more in like in the private markets. So we also have to keep in mind that moving that risk from one side to other, or for example, moving it to reinsurance companies, you still have that counterparty risk, right? And so that aside, another thing that might pop up in the future is some kind of intergenerational inequality. And what I mean by that is the future generations might be asked to pay an additional premium through higher contributions to fund part of the benefits or the promised benefits to the current generation. So now if we go back to the question and see how, like, let's say if we see the GCC pension funds, how they are right now, in my opinion, I think there should be a focus today on, again, increasing the state pension age or the retirement age, especially given the fact that people are living longer than before. There's still a gap over there. Second, to encourage the higher levels of the private savings or alternative savings solution. That would definitely reduce the dependence on the public plans. They will allow them to redesign their plans while ensuring that their retirement income is going to stay adequate to its citizens. In addition, I would still like, I think the promotion or the encouragement of higher labor force participation, especially for those at older ages, is key. Now, if we want to look at it from a reinsurance sector or how like that can, if that risk can be transferred into the insurance sector, I believe that today it might be a bit too early to think of it that way. In the event that private pension plans or defined contribution plans, they become more evident in this region, I think that would create some kind of an opportunity to buy annuities, deferred annuities, or longevity insurance. There's also other managed payout plans in the regions, or not in the region, from an insurance perspective. So again, if you also mentioned expanding that system to include more pillars. Again, my opinion, or the way I see it, having the second and the third pillars when it comes to the private pensions or private funded pensions and voluntary funded pensions, it would definitely help with that. Yet we also need to keep in mind that like that longevity risk, someone has to bear that risk, right? It's either the plan sponsor or it's going to be the individual. In a DB plan, it's always the plan sponsor. When it moves to a DC plan, it would be the individual who would bear that risk. And that risk for them to outlive their money or their sources of funding is also very important to keep in mind. So you need to balance it. It's the way it can be done. It's either by shared risks or having an income coming from multiple pillars. So if one of those pillars was short, it would be covered by the other pillars.
Great. Maybe I'll come to you, Jean-Xavier, on this. We've talked about these different hedging tools, etc., as a way for pension funds to manage some of these risks better. But everything comes at a price. What are your thoughts in terms of what are the costs of such an approach vis-a-vis others, and how much of this burden can we actually put on the pension funds? There's an audience question, which is, isn't this effectively something bigger than the pension funds and should be handled by governments at large? But perhaps finally on that, are there other countries which you would hold up as examples for the Gulf countries to to take a look at as they address these issues?
Sure. Thank you for the question. It's indeed a key key input in the discussion is the relative price of the different options and who is actually funding this risk hedging. As just mentioned, the different I would say risk hedging tools that are available are mainly through private sector tools, longevity swaps or specific insure product that would where the risk would be fully transferred. Now you have to keep in mind that these private sector players are in, although they have obviously a very precise knowledge and probably some views, but they are more or less in the same situation as we all are, meaning that making predictions over 50 years or 100 years is really a very difficult exercise. So when basically a hedging instrument has to be priced, it's factoring in a lot of risk embedded in the lot of potential mistakes in the projections that can be made. And as obviously these private sector players, even though there is a counterparty risk bearing, obviously we have seen in the past several insurers actually defaulting, which actually put a lot of pressure on specific pension funds in the US, for example. Now, having in mind the regulation, the heavy regulation insurers are currently facing, basically the default risk is not as pronounced as it could have been, but then the cost associated with providing such hedging tools has increased significantly. So when the discussion comes, I am better off actually using one of these hedging tool in my pension fund as a way for the sponsor to actually transfer the risk to a third party, or should we keep the risk inside the pension fund? Now it's really a discussion, I would say, a social, an overall, and a holistic discussion that has to be made with all the different players around. So if you think of the few examples that we have, so currently, for example, in the Netherlands, there has been a discussion going on currently with all the different social forces and the different stakeholders in the pension system, with the idea to really ensure that pensioners and workers have a clear idea of where the current situation would actually end up, meaning having to cut pensions because of the financial instability of the overall system, and to have an agreement of a risk sharing, of a sharing of the cost of this hedging between private sector, pensioners, and the overall government to make sure that there is really I would say a socially bearable cost sharing of that cost. So every situation is particular to every specific countries, but then if you look at the individual pension fund level, and I would refer to a paper that wrote that one of my colleague in Amundi, Marie Brier, wrote a few years ago, when you try to compare really the cost of external hedging versus the cost of bearing the risk within a pension fund and actually mutualizing the risk via intergenerational solidarity mechanism, usually there is a preference for the second option because of all the I would say the capital burden and all the costs associated with the insurance product and these hedging providers. So really the direction, and so that's not really a surprise that these collective default defined contribution funds are really the one that are really on top of the news flow these past few years. It's really because it's really at I would say the conjunction of the price efficiency, social efficiency, and really a way to really ensure the sustainability for financial sustainability for these pension fund systems. Now, of course, that comes at a price, and we already discussed that in detail. Is the fact that there is no free lunch. So at some point in time, the only way to actually face and to solve these demographic changes and longevity risk is to make sure that either you contribute more or you just receive less during your pension. Having in mind what I just mentioned earlier is the fact that there will be a third dimension that might complicate the problem, is that even if we keep the financial return that a defined benefit pension fund could actually achieve in the future, might be depressed compared to what have been able to be done in the past. So it's really a matter of negotiations between the different stakeholders in order to have this smooth transition to systems that would really be as fair as possible for the different players.
Thank you very much. Now, Omar, I have generously saved the toughest question for you. Okay, so I think it was Peter Drucker who said that culture eats strategy for breakfast. You can have the best laid plans, but old habits die hard. And what we've heard from the colleagues at this panel is that there are multiple tools that governments, pension providers can use to address the longevity risk, to address many of the other challenges associated with pension provision. We have also heard that the reform journey, if you like, in the Gulf is very long, given the kind of simplicity to date of the regional pension systems and their exceptional generosity, especially when viewed from the perspective of the demographic challenges ahead. Yet, as you yourself pointed out, we are also dealing with societies that lived through several decades of relative plenty, carefree lives, the rentier societies where the government provided for everything, and many people's thinking often is quite myopic, quite short term. These kinds of long-term structural reform issues we'll worry about tomorrow when tomorrow comes. So what's the way forward? How do we deal with this?
So one thing to note, again, we'll go back to the issue of migrant workers. And this is, arguably the, technically speaking, easiest solution available to OECD countries, which OECD countries are refusing. So a country like the US can make a significant proportion of its pension problems go away if it decides to let in a lot of people, and it certainly has space for a lot of people. But the primary barrier to that is a present cultural or nationalistic aversion to allowing more immigrants in. This comes, so in the case of the Gulf countries, that aversion, generally speaking, isn't there. But it is a potential solution is to continue to allow large amounts of migrant workers and get them to pay taxes and exploit the fact that the OECD countries are closing their doors to migrant workers. So it's a bit Machiavellian, but the reality is that countries like the UK, the US, France, where traditionally many people have looked to emigrate, are saying no to large numbers of people. And if the Gulf countries are smart, a lot of the people who would have gone to those countries might be interested in coming to the Gulf countries and paying a tax. It doesn't have to be a huge income tax, 2%, 3%. It would still make it economically worthwhile to them. Now, that would raise some questions about the political side of things. But I do think that it's still, there are questions that can be answered satisfactorily, given the limited nature of alternative options that many of these economic migrants have at present. And they're not getting any better, they're getting worse. In addition to that, and we've seen this sort of happening indirectly with the imposition of VAT, and VAT has been raised to 50% in Saudi Arabia, it's about to be raised to 10% in Bahrain. Oman is going to introduce an income tax. And all the Gulf countries were also incidentally signatories, I believe, to the current corporate 10% corporate minimum corporate tax that was international agreement. I can't remember who was spearheading. I think it was the OECD who was.
OECD, yes.
It was the OECD.
And G20.
So there are opportunities to increase taxes and to therefore funnel these taxes into covering for the liabilities, especially via migrant workers. In addition to this, also on the revenue side, they've already the Gulf countries all have sovereign wealth funds, which de facto act as pension funds, and they can continue building on those. But what I would recommend is that these sovereign wealth funds become more transparent and become totally delinked from the government's executive branch, to ensure that these things are managed from a financial perspective optimally, similar to, for example, the Norwegian Sovereign Wealth Fund, and are therefore, constitute much more reliable sources of future income. So that's on the sort of, balance sheet side. But in addition to the balance sheet side, I would emphasize that there needs to be an effort to tackle, the widespread financial illiteracy that exists in the Gulf populations. People, the saving rates are low for a variety of reasons. If you use the Drucker quote, there's a culture of low saving. Part of it is due to the cultural heritage. The reason, if you grow up in a region, if you're raised in a region which has been nomadic, many parts of Saudi Arabia, UAE, Kuwait, nomadic up until the recent past, and it's unsurprising that someone who's grown up in a country that's been nomadic, or a territory, I should say, because they're not even countries for most of history, but have been nomadic, is someone who doesn't have a mindset that looks too far into the future, because if you're living in the desert, you're lucky if you make it till next week. You're not really thinking about what you're going to be doing when you're 65. So it has to be some sort of wide scale fundamental education. Financial literacy has to be something that's included in curricula. And my children are going to school now, and in their school, I noticed my 7-year-old daughter is being taught the SDGs. So probably by the time she's a teenager, she'll have a much more mature sense of sustainability than I did when I was 15 or 16, when it wasn't something that was on people's in school curricula. So financial illiteracy, which is partially due to the cultural heritage of being nomads, and partially due to the rentier state we mentioned earlier, has to be addressed head on. People have to learn to start saving for themselves and taking responsibility for their pensions and for their financial situation. I think when you asked my fellow panelists about some examples of where this is done well, I believe Singapore is, as usual, one of the countries which is quite proactive in this regard. In addition, and here you mentioned that this, both you and Shireen mentioned that this is something. This event is hopefully something that starts the conversation. It needs to encourage open discussion of pension problems. Unfortunately, in the past, the only discussion that's come up of pension problems has been at the time when an unpopular decision has had to be made. And that sort of reactive discussion is not very conducive to light in the discussion. It's more conducive to heat in the discussion. On the contrary, it needs to be something which is addressed structurally and continuously, and by all members of society, and not just waiting for things to reach a crisis point and then put together a forum and hope that everyone goes home, feeling a little bit less angry. But go ahead.
Yeah, but there's a potential tension in your answer, because, of course, your idea of open the gates and tax the migrant, again, I accept the idea, but you are really talking about replacing one kind of rent with another kind of rent. And while these broader issues are, you acknowledge them, how do we make sure that the policy debates don't get hijacked by people who do the former and not the latter? And
who do which one? Sorry, what's the former?
So essentially, tax the migrant and forget about everything else.
Yeah, so I think that so taxing the migrant, to clarify, I don't mean just taxing the migrants. I think everybody needs to be taxed, but it's going to be what will generate considerable revenues will be taxing the migrants in tandem with taxing the local population, for the simple reason, unfortunately, that the migrants tend to be a lot more productive than the local population. And so when you tax them in the large scheme of things, that will generate more revenues. But I definitely, it should not be a singling out of migrant workers or transforming them into a source of rent, as you mentioned. So everybody needs to be taxed, and then that needs to go hand in hand with the sorts of reforms that people would be asking for if they were getting taxed, so that they feel comfortable getting taxed. And we've seen that already, you know, in several Gulf countries. We see a lot more, you know, transparency in budgets than there was before. If you want to take the example of Bahrain, when the decision to, you know, increase VAT recently was made, this was done in a press conference. There was an opportunity for these issues to be discussed openly. This issue has to go past Parliament. Parliament are allowed to veto it, and all these checks and balances exist as a consequence of the, you know, partially as a consequence of the realization by the government that they need to start collecting more tax revenues. And I believe you'll see similar things in the other Gulf countries. So I think going in the right direction, maybe not as quickly as they need to be, but they're more or less aware. But if they move more quickly, they could see some of the opportunities that OECD countries are making available in terms of the xenophobic migration policies being adopted.
All right, thank you. Now the clock is ticking, so we are nearing the end of this panel. Maybe I could ask each one of you to make a one sentence recommendation to policymakers in the Arab world. What should be item number one on their agendas tomorrow morning when they think about the pension system? Let's do ladies first, Shireen.
Right. I think we have to take a holistic approach. I have to embrace that we are aging, and it's a good thing. We need to think about aging and healthy aging, and think about work as an important element of that, but also think about work and employment for everybody in the society. I have a lot to comment on Omar's migration, but I wouldn't do that. But we really need to think about migrants and citizenship rights. So in the US and UK, it's not just because migrant workers, they have rights and they have benefits and they have roots to citizenship. This is not happening in GCC countries. So I think
in migrants are not. It has started to happen.
Yeah, some rights. Yeah, I would say, but I think the conversation is beyond the nationalist. I think the conversation is much more complex, and hence the solution is not as simple as get more migrants and tax them. I think get everybody working, get the taxation right, get the contribution right, and really change the perception of aging at a societal level. So that's really important. This is happening very fast. As I said, I keep repeating this, but in 2045, most of the Gulf countries will be already aged population. This is quite scary, and we have to have a big shift in our thinking and our attitudes toward aging and toward work and toward financial savings. And financial literacy is absolutely important, absolutely a brilliant point.
All right, thank you very much. That was quite a long sentence, if I may say so. Now, Hazem, over to you.
Thank you. So I would say, like, promoting the savings environment for individuals not to rely on a pillar or two, and to rely on more of or to take into consideration the 5 pillars would be my recommendation.
So take charge of your own destiny. What about you, Jean-Xavier?
Well, as far as I'm concerned, I would echo what has just been said, is try to be as proactive as possible versus being reactive, in order to make sure that you can have this smooth transition that has to be done in quite a speedy way in the GCCs, and ensure that you encompass, that you really understand and appreciate all the risks that you are facing. So hence ensuring that you have a financial culture that is very well spread out, and that your actually population is aware of the different challenges that can be faced for their future generations.
So we banished what they call the Frank Sinatra philosophy of trouble. Don't touch it, maybe it'll go away. Even though there is a lot of sand available, we won't bury our heads in the sand.
Yes,
Amar,
exactly.
your final recommendation.
Yeah, I would affirm the need to be transparent in every walk of life. So transparent with its sovereign wealth funds, transparent in terms of government finances, transparent in terms of people's personal saving plans, and so on. Just embrace transparency, not as a source of a headache and it's going to lead to questions and so on. Use transparency as a way of helping, believe in it as being a way of helping people take better decisions individually and collectively.
Great. Thank you very much. We have covered a lot of ground. It's a complex issue, so I don't think we are even close to being done with it. But I'm glad to see that the conversation is evolving as really at this point it should be. Thank you very much to all of you panelists. Thank you for to the audience, and of course, thank you to Ibrahim and FinTech Robos. And I wish you all a good rest of the day and rest of the conference.